This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Right, are you ready? Let's go through and have a look at a group statement of financial position question that involves changes in group structure. So strap yourselves in. It's a really good question. It's a big challenge. So let's have a look at what we have. Okay, again, you can see up there, you've got three companies. Is it Riley, Hume, and Jones? Okay. And you've got the statement of financial position for December 2015. So nothing too exciting there. And it wants us to go through there and prepare the consolidated statement of financial position for the Riley Group. So that must be the parent, and the year-end note is December 2015. Okay. The information that you're given, again, at the start of the question, similar to what you'd see within a real P2 exam question, is all the background information to do with the group accounts, or the group structure, retained earnings, and help you with fair value of the NCI to plug into all the workings. Okay. Here, it's so important to understand the group structure. So what you've got there is it says Riley acquired a 60% holding of the equity shares of Hume on the 1st of January 2014 for cash consideration of 75, retained earnings 25, NCI at fair value was 40. So the usual information. I think we're really comfortable now with the way the information is presented. The vitally important aspect here is that on the 31st of December, we acquired a further 10% for a cash consideration of 15. Okay, so what you've got there is that if we have a look at the situation and look at your workings, and look at our group structure, we've got there Riley that owned, was it 60%? Yep. Of Hume. It now has another 10%, doesn't it? And what you've got there is that we previously had 40% as the NCI. There is now a 30% NCI. Okay, and that change happened at the year end, didn't it? That change took place on the 31st of December 2015. So the change in the non-controlling interest, that reduction in the NCI takes place right at the last second of the year end. Okay, so we'll need to work out what the NCI is immediately before that change in ownership and then adjust the NCI. The second situation that you've got is it says Riley acquired 90% of the shares of Jones. So again, Jones is a subsidiary. That's on the 1st of January 2014, so at the start of this year. Again, usual nonsense. Cash consideration 120, retained earnings 35, NCI again at fair value is 13 million. The big change here now is that at the end of the year, you disposed of 20% of the shares in Jones. So what you've got there is that you have Jones. You previously owned 90%. You disposed of 20% to take you down to 70. The non-controlling interest was 10. The non-controlling interest is 30. So what you've got to do there is you need to give the non-controlling interest 20% more, isn't it, of the subsidiary. So we need to give it 20% more of the net assets and 20% more of the goodwill, isn't it? Okay, so it's vitally important that you make that distinction in terms of what is happening. Okay, yeah, when you look at the acquisition and Riley acquiring more in Hume, the non-controlling interest is reducing, so we're giving back to the non-controlling interest some of their NCI. Okay, so here what's going to happen is that if the NCI was 40, it's now 30. We're going to have to give, is it 10/40ths of the non-controlling interest at the 31st of December 2015, isn't it? However, with regards to Jones, be very careful. We're giving the NCI more of the net assets. So the net assets of the sub plus any goodwill. Okay, so that's going to be vitally important in terms of the calculations, which we can then feed in, if you like, to the workings. Key bit is at the end of the day, we still own 70%. We still own 70%. So Riley's the parent, Hume is the sub, Jones is also the sub. So we're just going to consolidate them as normal. Okay, so we still need to add across the assets, the liabilities. We still need to go through there as well and play around, don't we, with regards to calculating the goodwill. And then we can think about the NCI and the group retained earnings. Okay, so let's have a look. Having already looked, was it at working number 1, your group structure? Let's go through there and have a look, shall we, at working number 2. Working number 2 is looking at the net assets, and we're going to first of all look at Hume. So looking there, is it at the reporting date, the acquisition date, and post acquisition? Okay, so remember, share capital and retained earnings. There may be some more we don't not yet know, but remember the reporting date figures come from the SFP, don't they? So we need to go back to Hume's SFP and find out the share capital and retained earnings. What you can see there, share capital 80, retained earnings 65. Again, here we're working in millions because that's how the financial statements are prepared. Okay, so share capital 80 at the reporting date, 80 at acquisition. What were the retained earnings? The retained earnings of Hume were 25 million. So I can add in 25 million there. No adjustments because, again, I'm keeping it as simple as possible. I want you to understand the group aspects before things get more complicated. So is that 145 and is that 105 post acquisition 40? Okay, excellent. Everybody happy with that there? Okay, excellent. If you want to go through and do it yourself, you could go through there and think about Jones. So you can do Jones's net assets, and then what you could also go through and do, just to keep yourself involved, you can do working number 3 and have a go at the goodwill. Okay, so what you can do now, if you want, stop or pause the video and then come back once you've worked out Jones's net assets and once you've worked out the goodwill for Jones and also Hume. Okay, so stop the video now, and hopefully now you've restarted it. Okay, did you do it yourself? I hope you did. You've got to try and keep involved and keep working it through. So what we've got, hopefully, these are the figures that you've got. Okay, so at the reporting date, at the date of acquisition, and is it post acquisition? Again, sorry to bore you with the same speak, but it helps it sink in. The statement of financial position is where you get those figures for Jones, and they are 75 and 45. Hopefully that's what you had there, wasn't it? 75, 45, share capital, retained earnings. Copy across the share capital. Hopefully you've already got all this down because you did it yourselves. And the retained earnings were there as 35 million. Again, no book value to fair value adjustments. 110. And is it 120? That gives me there, is it 10? Okay. Goodwill, hopefully you laid it out in columnar formats, because that should make it a bit easier. So we've got Hume on the left, Jones on the right. The fair value of the consideration. Essentially, how much did we pay for each of them? We paid 75 for Hume and 120 for Jones. So 75 and 120. We then add on the non-controlling interest, which I think here was at fair value. So the non-controlling interest at fair value, 40 and 13. And then we can deduct working number 2 at the date of acquisition, can't we? So what have we got? For Hume, it is 105. For Jones, it is 110. Okay, so deduct 105 and deduct 110. What have we got? 75 plus 40 less 105. Does that give me 10? And then 120 plus 13 less 110 gives me, there is it, 23. So the total of your goodwill is 33. Okay, did you all get that? Excellent, well done if you did. Okay, well done for stopping the video and doing a little bit of the work yourself. That's what you've got to do. The more work and practice you put in, the better you become. So saying that, what I'd like you to do is forget about everything to do with these changes in ownership. What I'd like you to go through and do is, I would like you to go through now and work out the non-controlling interest. Working out the non-controlling interest before there are any changes in ownership. So when you're looking there, is it at Hume? Before there were any changes in ownership, Hume was at 60% ownership and a 40% NCI. So Hume is at 40%. And Jones, we own 90. So 10%. So what I'd like you to do is, I'd like you to do the calculations under your own steam. So restart the video once you finish them and stop the video now. Did you stop the video? Hopefully you did. Okay, getting used to it. All good. Let's go through there and see how we got on. So non-controlling interest at acquisition for both of them. Is it 40 and 13? Okay, so 40 and 13. Then what we go through and do, remember, is we add on our share of the post-acquisition figures, which come from working 2, isn't it? So here, Hume, we're going to take 40%. Jones, we're going to take 10%, aren't we? Okay, because remember, all the changes in ownership happened on the very last day of the year. So we need to get the NCI correct first before we then make any adjustments to it. So what have we got? Post-acquisition profits of Hume are 40 and of Jones are there as 10. Okay, so 40% of 40 and 10% of 10. 16. Okay, and is it 1? Yep. Okay, totaling those up give me 14. Totaling that up gives me 56. Okay, hopefully you got that there. Again, what we're going to do is we're going to ignore the changes in ownership. Okay, we're going to keep that entirely separate. Okay, we'll come back and finish off the changes to the NCI, etc. in a moment, because I'm trying to demonstrate that even though there are changes in ownership happening within this question, if you have a fundamental knowledge of group accounts from what you've seen from F7, you can pass any of these questions. So again, what we've got there is we need to put in, is it 100% of the parent retained earnings? So the parent retained earnings are 110. Right up to the very end of the year, we own 60% of Hume. And Hume's post-acquisition profits, I think, were 40, weren't they? Double check. Yeah, we previously owned 60%, didn't we? And then the post-acquisition profits were 40. If we go through there then and think about, is it Jones? Right up to the end of the year, millisecond before the clock struck midnight, we owned 90%. And the post-acquisition profits were there as 10. So we're going to add in 90% of the 10 from working 2. So that's 9. And is it 24? Okay. Again, I'll total those up. Is it 245, 145, 110 plus 24 plus 9, 143. Always use a calculator. Okay. Yeah. Excellent. 143. Again, let's carry on without thinking about the changes in ownership. Working number 6 is our group other components of equity. And again, we start off with 100% of the parent. 100% of the parent, other components of equity are 10. There is no post-acquisition movement in any other component of equity with regards to either of the subs. Okay. Could you do all of that in the exam? I have every confidence in you doing that within the exam. The difficulty that you've got now is dealing with the change in ownership. Okay. So let's go through and first of all deal with Hume. Okay. So we'll look at that first. Yeah, we had a 40% non-controlling interest. The non-controlling interest now own 30% of what they previously owned. So to get it to the 30, remember, we're saying there's your cake for the NCI, of which there are 40 slices, each one representing 1%. So in total, it's worth 40%, isn't it? If we take out 10 slices, which is equivalent to 10 percentage points, we're taking out 10 40ths, aren't we, of that non-controlling interest. So it's vitally important that we take 10 40ths of that NCI. So in Hume, in order to get us down to our 30% holding, we need to multiply by 10 40ths of the 56. That goes through there and gives me 14. And that goes through there and gives me, is it 42? Okay. If we're thinking about the journal entries, what we've got there is we have bought some more shares, haven't we? So we have credited the bank. How much did we pay for those shares? 15 million. So we've credited the bank with 15 million. We have debited the non-controlling interest with 14 million. The balancing figure is a debit to other components of equity, which is 1 million. Okay. We've effectively processed the debit to the NCI because this 42 is what will appear on the group statement of financial position. Okay, so we've already processed that. We need to process the debit to the other components of equity, which is there as 1 million. So a debit reduces your other component of equity. So that's in relation to Hume, isn't it? And we can take that from our working for. Okay. We don't need to go through there and adjust, is it for the cash entry? Because they've already adjusted for that within the financial statements. They would have credited the bank and then they would have gone through there and changed, if you like, the value of the investment. Okay, debited the investment, so to speak, because they legally have bought more shares. Here, we're just over there. We're just accounting for the substance. Okay, so the credit to the bank we can ignore because they will have already processed that. The only reason why I'm writing it out is to work out what the balancing figure is to your other components of equity. Okay, excellent. In terms of what then happens, is it with Jones? We'll look at that next. So Jones's NCI was 10%. We're now giving them 20% more of the subsidiary. So what is the subsidiary worth? Well, the subsidiary is valued based upon the net asset and the goodwill. So what we're going to go through and do there, in terms of our calculations, we are going to go through there and take 20% of the net assets at the date of change, which is the end of the year, and add on any goodwill. So the goodwill figure of Jones is 23, and the net assets at the year end are 120. So if we go through that and do 120 plus 23, 120 plus 23 is 143. 20% of that is there as 28.6. So the non-controlling interest increases by that 28.6, because remember, we are selling the shares, and as we sell the shares, the non-controlling interest begins to increase, doesn't it? So here, as we sell the shares, we are going to debit the bank. How much did we sell those shares for? Well, we sold those shares for a cash consideration. Is it there? 35 million. So I debit the bank with 35 million. I credit the non-controlling interest with the 28.6 million. And I will credit other component of equity with 6.4 million. Okay, again, that credit entry is a balancing figure. Okay, by putting in the non-controlling interest at 42.6 in the SFP in a moment, we have effectively gone through and credited the NCI. I need to credit other components of equity with his at 6.4. So I will add 6.4 to do with Jones, which has come from working for. So if you want, you could total that up. Does it give me 15.4? Okay, yep, 15.4. And then what you've got, again, you don't need to concern yourselves in working number 4 with the debit entry to the bank, because that will already have been dealt with within the parent's books, whereby they debit the bank and credit the investment based upon the legal side of the accounting treatment. Okay, and breathe. Okay, we've done all the workings. We need to give ourselves a bit of time to actually do the consolidated financial statements. So what we've got there in terms of our consolidated financial statements is we need to go through, don't we, and prepare the group SFP. So there we need to begin to go through there and start to consolidate by adding, by adding things across on a line by line basis as the